All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. By far the most requested topic for me to talk about over the years has been pricing options. And it is something that several have reached out asking some questions about, and want to kind of speak to it here today. This video is not going to be very long, but going to talk about pricing options for swing trading. We're going to do it the easy way. We're not going to deal with the delta, gamma, theta, vega, rho, Greek stuff. We're not going to put any fancy math into this. We're just going to do it the quick and easy way. And yes, is it going to be 100% accurate? No. But can we get the can we get the idea of whether or not our option's expensive or whether or not it sets up well for us in terms of a trade? Absolutely. Right? And so that's what we're going to do. If you want the more complex versions, if you just go into the video library, hit price, type in pricing options, there's a whole slew of videos about it. But we're just going to go look at the easy way. Now, if you're day trading, what I'm going to talk about doesn't apply. If you're day trading, you look at your option and you say, okay, what's my delta? Do I have a good enough delta? Great, go. You're good, right? You don't have to worry about, time decay and volatility effects and all of that kind of stuff, right? Those don't matter all that much because you're only in the trade for a certain period of time. But when you're swing trading, other things matter. Now, when pricing an option, the first thing I start with every single time is the chart. Let's just take the SPY. Okay? Let's just take the SPY. I start with the chart. And I don't know, do you want to be bullish or bearish? Let's actually be both. Let's be bullish and let's be bearish. And we'll take a look at, the option pricing. But first thing I have to understand is, realistically, where do I expect my stock to go? Realistically. And I know something crazy could happen. And you know what? Tomorrow the market could be at 250 or it could be at 290. But I'm not going to price in abnormal, right? We'll base on normal. If abnormal happens, great, we deal with it. But overall, we'll deal with normal, right? And let's just start with the call side. Let's just start with the trade higher, right? How high would we expect a bounce to go if the market itself, were to bounce? 276, 278. That's kind of a realistic area. That's kind of in the retracement area, right? Where would I want to be out at? Well, let's just say today's low, right? Let's just say today's low, 270.35. So it's about $1.20 away, right? And so we put in our parameters. Our stop is about $1.20 away. And our price target is about what? About $6 away. Okay? So nothing exacting there. Nothing, absolute math, craziness. But that's what I have to start with. If I'm going to go out and price an option, this is where I start. Now I go take a look at my option chain. I come into trade and I click on the chain and come in here to the SPY. And I'm always going to start out a month, right? Because if you start to get a feel for how they're priced out a month out, then you can start to look at other things and start to kind of see, okay, how does that shift? But here we are. Let's go with this 272, and it's trading at 603 to 612, 604 to 612. Great, it'll shift a little bit here. But it's going for about $6 on this call. Okay. Now where do I go? Well, this call gives me the right to buy the stock at 272. So, if my stock goes up $6, it's going to go up to what, 277? What's the real value of my option? Right? If I buy the right to buy this stock at 272 and the stock goes to 277, right? I can go and buy it for, or I can go buy it for 272, sell it for 277. It's worth $5. You just subtract them, right? You take the 277, you minus the 272, it's worth $5. You said, well, wait a minute, my option's worth $6 right now. yeah, it's worth $6 right now. That is assuming this 272 to 277, this subtraction of the strike prices. This is dealing with the option value at expiration. Okay, on expiration. Is that a good value? Is that something I want to be in? If I have a view that it's going to take a month to get up to 277, do I really want to buy this option? No, not at all, right? Absolutely not. Because even if I'm right, and even if my stock goes to 277 by expiration, I've lost $1. Well, that would stink, right? I've lost $1. So is there any real reason for me to even worry about stop or anything like that? No. This is one of the difficulties in going and buying options in the market today with the higher implied volatilities. Is if it's going to take 30 days for your option to get there, your stock may have gone up a lot, but your option value will have gone down, and in many cases down a lot. But let's talk more practical terms. Okay, this is all well and good to look at what the absolute value would be on expiration in a quiet, modest market, right? In one that it's just moving a few points a day, right? Then that kind of comes into play a little bit more. But we're talking about a market right now where, look, the market could be up 60 points tomorrow, it could be down 60 points tomorrow. So how do we figure and go, well, all right, is there value in this option that I can hold it for a week and actually make it pay off, right? How do we do that? Well, very simple, right? Very simple. I expect the stock to go up by $6. Okay, easy enough. Take my 272 strike price, and this one's every dollar strike, so I can go back 6 strike prices. 1, 2, 3, 4, 5, 6, right? I come back to 266. What's my option worth? It's worth $10. So if today, theoretically, the market were to, or the SSPY would go up $6, my option would go from $6 to $10. Now, in the back of my mind, I know that every day that doesn't happen, there's going to be some time decay, and there's going to be some implied volatility loss. So I look at that and I just say, okay, every day it's going to cost me, it's going to cost me 10, 20 cents on my option, right? About 1% on my option. That's the way most of them are. I don't take that into consideration, but I know that's always going to be a risk of holding it. So I have to say, look, it goes up $6. I'm gonna make $4. So I'm gonna make $4 off of a $6 trade. That's if I'm dead right. That's if it happens right here, right now. Is that something you really want to get into? I mean, is that something that even makes sense even if you know you're going to be right or think you have an 80% chance of being right? Is that really going to pay off? Because let's face it, it's probably going to take a week to happen. And if that happens, you know you're going to have time decay. So your option is probably going to be worth $8 to $9 instead of that $10. So you start looking and going, wow, that really cuts into my return, into my reward. Okay. But now you have a choice to make. Now you can decide, right? Now you can say, hey, you know what? This is what my return is likely to be. Is it really all that worth it? What's your risk, right? Well, let's say the 271 option is going for $6.70 right now. If it's $1.20 against me, I come out $1. It goes from $6.70 down to $6.10, or $6.60 down to $6. So I have about a 10% risk on my option. And anytime I'm just doing an estimation like this, I add another 10%. Okay, I always add another 10%. So I look at it and I go, okay, I have 20% risk. So I'm going to risk 20% for something that in the absolute best case scenario, it moves my way today, right here, right now, pays me off 60%. But realistically, if I'm right, I could still lose money. And if I'm right in the next week, I'm going to make about 40%. Now I can make a choice. And I'm not saying it's right or wrong. I'm not saying, hey, do it or don't do it. For each person, it's a little bit different. But for me, that's not something that feels all that great. It just doesn't feel all that great because I know what's going to happen. If I wake up and the market tanks, I'm going to be in a big loss. And I really wasn't in a reward position to really, make out big if it did the opposite. So what's the point? I mean, the whole point of options is so when you're right, you get paid big, and when you're wrong, that loss is capped. And so if I have, a loss that is potentially every dime I put on it, but a reward potential that isn't really all that great, do I really want to be involved? Right? Do I really want to have anything to do with it? The answer is no. For me personally, right? The answer is absolutely not. Okay. Now we can go look at this on the put side, and let's come back to our chart and say, okay, where would we expect the stock to go? Well, let's just say lower Bollinger Band, 264, right? 264. Where's our stop? 274, today's high. So our stop is about what? $2 away from where it is. Let's go 250. All right, 250 away is our stop, and our reward potential is what? $6, $8. All right, let's just go 8 for the sake of simplicity here. Again, we're not doing any kind of real fancy math. We're not getting to the penny here. We're just getting a rough estimate. All right, 250 and 8. Let me erase those. Well, let's say we go buy the 272. Right? We go buy the 272 put. If it goes $2.50 against us, what's it going to be worth? Well, let's chunk on down. $2 and $2.50. So the midpoint of this 270, 269 option. So it's going to be about 520. So we put in 620. If we're wrong, it's worth about 520. Okay. We're risking about $1 here. Okay. Well, what if we're right? What if we're right? 272 up to 280. Our option is going to go from 620 up to 1040. So we're going to make what? $4? That's if it happens right here, right now. It's the same price as, it's the exact same thing or a very similar thing to what we saw on the call side. Do we have a great reward potential if we're right? No, not really. But if we're right, we'll make $4. If we're wrong, we'll lose $1. Is that a little bit better risk-reward scenario than what we saw on the call side? Yeah, it was. But we have to realize that, well, yes, our reward potential's 4, our risk is $1. Every day that goes by, that skews a little bit. Our reward potential is now $3.80. Our loss potential is $1.20. The next day that goes by, it's $3.60 and $1.40. Next day that goes by, it's $3 reward and $2 risk. Right? So as time goes by, it changes that element. As a rule of thumb, if I can't at least through this rough math see that if I get to my strike, if I get to my target, I will at least double my money, I don't want anything to do with it. Because it's not worth the risk. And generally, I'd like to see that I can do more than double my money. A triple is kind of what I'll aim for. But when we have higher implied volatility environments like right now, that's not always realistic. But overall, I can quickly eyeball it and say, look, these options just aren't worth it. They're just not worth it to me. So, all right, let me go down and get rid of some time, because a lot of that's time, right? And let's just go out a week. And let's come to this same 272 put. Instead of for $6, is going for $3. Okay, so if the market drops $8, right, it's going to go from 350 up to $9. That's a little different, right? 350 up to 9. If it were to happen right here, right now, by buying this option, that's a lot better return. But what don't I have? I don't have much time for that to happen. So it's always a trade-off. And I'm not saying which one's right, which one's wrong, choose this one or choose that one. You can see people choose different ones all the time based on their needs, based on their expectations. But by just quickly looking at the option chain, you'll notice we never looked at delta, gamma, theta, vega, and rho. Quickly looking at the option chain and just going up or down the chain, right? We expect the stock to drop $6, so we look at the chain and we drop it down $6. We can see what that option would be worth if it happened right here, right now. And then we can start to discount a little bit for time. We don't need any fancy mathematical equation. We don't need, any option calculators. We don't need any of that stuff. In fact, many times that stuff can just kind of get in the way. For the most part, options are priced pretty fairly. When will you see a big change or something really different? Well, you'll see that when implied volatilities are up, when implied volatilities are elevated or ahead of earnings or ahead of a big event. But we know right now that most options, they're going to be pretty heavy. They're going to be pretty hefty because we're getting bigger swings in stocks. Okay. That doesn't mean, hey, don't make the trade, because you can expect a bigger swing in the stock, right? You can expect that. That's realistic. But it also means that a small change in your stock generally is going to equal a small to no change in your option. So you're going to need the bigger move, to pay the option off. Okay, so hopefully that helps a little bit, to kind of see, hey, an easy way, just looking at the strike prices, going up or down, what you expect the stock to move, and that could give you a really good estimate in a very simple way. All right, now as we've been chatting here, the market's taking a little bit more of a leg lower here, coming back to its lows on the day. You can still see, even these moves right here that we're looking at, these moves, 2706 up to 2718. So this is a 12-point move in 8 minutes, and then drop 13 points in, 7 minutes? Right. We're still dealing in a market that just doesn't have a lot of price stability here overall. The volumes are slightly elevated, but we don't have anything suggesting bottoming volume in play here. And, still one of those where, you can see it on this 15-minute chart, the market pushing into some new lows here. This starts to get a little dangerous in terms of free fall levels. For the bears, right now it looks like there's some stop hunting that's going on. As people like to put stops right underneath price levels. And you see this happen a lot. You see a level like this, and a lot of traders, they will base and say, hey, you know what? I'm going to buy and I'm going to base it off of this level. They put their stop right there, and then boom, it gets knocked out. And they go do it again and say, I'll put it down a little bit. So, all right, the stop hunting gets a little bit lower, and you get just slightly lower. Then you get slightly lower, right? The market makers go and just drive those stops, and boom. Once those stops are filled, well, there's the sell pressure. It's gone, and you see some sort of quick type of rebound. So, it does look like some stops, are getting triggered here. But we start to break down. There's probably some more stops right under 2,700 here. Nice round number for a lot of people to kind of say, hey, you know what? I'm going to buy off 2,700. Why? Because, well, you know what? That was this low right here. That was this kind of level right here. You buy off 2,700. So I think if we start to see 2,700 break, the algos are going to flush this, to flush out all those stops there. And it's a level that if you're bullish, you kind of say, okay, break, and then when it snaps back to that level, there's your opportunity to buy, because those stops have all been triggered, and you can go and say, all right, let me get in. I'll use the low of whatever this stop flushing was as a general stop, and can navigate from there. Okay. Alrighty, thanks for hopping on. Any questions, please let me know, and we'll talk to you later. Take care.